Are live. We are happy to have you back here on Matt Money. Hopefully, you guys are having a great weekend or the start of it thereof. But yeah, nothing really to come to terms with at the end of this week. It's been a kind of up, down, and around sort of week as expected. But today, I just wanted to take an opportunity to set aside 20, 30 minutes. I know there's a bunch of other streamers that are kind of coming online at the 7 p.m. Eastern time frame. And so with that, I don't want to take too much of their time as hopefully have some viewers for those guys going into it. But there is a few things that I wanted to highlight specifically with respect to some of the cool things that some people have done and shared with us since we've started Cashflow Chronicles. Me and Hot Chris, as I like to call him, the Daisy God. So let me just pull up something that I thought was really cool that somebody actually pulled off a transcript from a recent video that we had done with respect to Dutch Bros. And it doesn't necessarily dive into Dutch Bros. So don't turn off the channel just yet, right? It's mostly just about prudent investing altogether. So I wanted to give a shout out to ETF FaceTime. He put this into, I guess, a program called Cloud. And he basically just texted the transcript, and it really just kind of summarized really in depth a lot of what Chris and I talk about in Cashflow Chronicles. And I just wanted to share that with you guys. I think it's really cool that this summarizes things really well. I'm like reading it, and I'm like, holy shit, like this is what, and it does it a lot eloquent manner than I do, right? I'm not the best and most eloquent speaker. So in that respect, it's not always the best thing to kind of come forth with, but this does it in a really, really good manner. And so having this was pretty cool to be able to see. So it took this entire transcript that we have and basically took this and summarized it. So Dutch Bros, let's just get this out of the way, is a rapidly expanding coffee chain, big growth potential, especially among younger generations, and it could be a Starbucks competitor in the long term. Of course, they're all in competition, but Starbucks has many, many locations at the moment, and Dutch Bros is just kind of getting into the space. The speakers haven't tried Dutch Bros yet. No, I have tried Dutch Bros, so let's just get that straight. But intrigued by its viral popularity on social media like TikTok. And I think Chris has tried it too in Vegas and many of the others. There's a lot of other people that chimed in saying they haven't, but they're intrigued with the popularity on social media and stuff like that. So definitely resonates with the younger demographics. Franchises like Dutch Bros can compound growth easily by just opening up new locations, similar to Chipotle's growth. Starbucks also grew that way. And you can invest in both value and growth stocks. A sword and shield balanced portfolio has both. Google is an example of both providing value and growth, which Chris and I talk about a good bit. And specifically Chris, he's very much hitting home on this on Twitter pretty much every day. As of late, writing up why he thinks Google will continue to succeed as we continue down this AI sort of path that everyone has kind of come to terms with. So Dutch Bros is a 34% year-on-year revenue growth last quarter. Profitability is almost improving after the COVID dip. Fast growth justifies a higher PE ratio, and the PE ratio right now is kind of not really necessary due to the fact that it's just getting to the point of GAAP profitability. So kind of keep that in mind. Technology like AI can improve operations, but it has to be implemented carefully and thoughtfully. Obviously true. And these last three, I think, is where the last two or three is where it gets really cool. And actually, I think this might be something that I messed up. This might specifically be about bros. And I think ETF FaceTime had one specifically about a different one. So I think I misspoke here. I didn't realize he had two of them. So this one looks like it's specifically Dutch Bros. There's another one that I wanted to highlight specifically about like investing and stuff like that. So let me just finish out this one. I see that there's another one up here. Getting in early on a rapidly expanding franchise, despite high valuations, can pay off huge in the long run. Starbucks was always viewed as overvalued too, just like Chipotle as well. The offerings seem very sugary, like liquid crack, but the social buzz and growth suggests Dutch Bros is resonating. And overall, Dutch Bros appear to be intriguing growth play, tapping into younger demos' tastes. Being early to a growing franchise story could reward investors despite premium valuation today. The key insights center around identifying growth trends early, balancing growth and value in investing, and looking past high valuations for big growth potentials. Dutch Bros seem very well positioned if momentum sustains. And then I wanted to pull up this one with respect to, he said he did this one. He didn't say specifically what episode it was, but this one was really, really cool. ETF FaceTime, once again, thank you for this one. And he just uploaded the transcript. And this one I thought was really cool. So apologies, I misspoke. And I thought that the other one was better. But yeah, this is from a video, dude. Yeah, very good. So yeah, once again, just wanted to go deep into this one because this was like going to put me and Chris out of a job. So I'm just going to like start every Cash Flow Chronicles with this statement here, and then I'll probably just never. I'll just not even be on camera anymore because I'm not very good looking and my voice isn't very good, and it cracks a lot as you guys hear. So I might just, put this up and just hopefully stream it for like an hour or two every day. And then sorry, long week. And then just call it a day. And I'm curious if that's what Chris wants to do as well. And any money we'll split between me and ETF FaceTime and Chris. But all jokes aside, let's hop into this one because I thought that this one was very insightful and it states pretty eloquently and succinctly a lot of what Chris and I talk about the channel. We kind of like go back and forth for minutes on end, but this hits it line after line after line. And then I want to do kind of like a little roundup as well, and then do some Q&A and kind of cut it off after the half-hour mark. So do your own thorough research before investing in any company. Don't just rely on others' opinions. Understand the business model, competition, valuation, etc. Very wise. I think that's pretty much all I talk about. I used to be somebody that would follow anybody in the water cooler into a position, and that can be fruitful if you do your own due diligence and you agree. But you just learn to find out. The more people you talk to, the less actual work they want to put in. They just want to reap the benefits and not really do any due diligence. And so, just listening to other people, it bothers me. Oh, whose yawn it is. I don't know if it's because it's Friday or what, so I apologize. I don't know if you guys have recognized it, but you could listen to some people, and they honestly have no idea what they're talking about. And so just be cautious of that. If somebody says they know everything about a specific subject, they're fucking lying. And part of my French there, but it's just the truth. So the second bullet point: diversify across sectors and asset classes. This portfolio included banks, tech, retail, infrastructure, real estate, etc. I agree, and I think to add on to this specifically is also know when to lean in and lean out of certain sectors. There's a really good book by Jim Cramer. That's probably going to cause a ruckus in the chat section as it is. But with that, Jim has a good idea. I think it's called Get Rich Slowly or Get Rich Carefully or something like that. Or maybe it's called Real Money. One of the two. I've only read two of the books, but so I probably mix them up. But it talks about sector allocation, business cycles, and it's true. Certain business cycles, certain asset classes are going to do really, really well, and some sectors are going to do really well. But in other parts of the business cycle, like during recessions or during growth periods, the reliance on different ones are going to do poorly. So just kind of think that. Oh, excuse me. As you guys kind of finish out and take that with the I guess a grain of salt, like when, for example, you kind of saw a mini cycle here from the midst of 2020 to 2022, and now kind of where we're at in the beginning of 2023. You kind of saw this, hey, we're coming out with all the stimulus, so growth, massive expansionary period, technology, all these things are going really, really well, going gangbusters. And then 2022, the feed got cut off, right? They started raising interest rates, and what happened? Technology. So it just looked at how well technology ran in good times, growth periods, and then pulling back, in 2022 when the drip kind of got cut off. You could see when things kind of get tough in a recessionary period, technology might slow a little bit. So just kind of keep that thought. Think long term when investing. Short term price movements shouldn't drive decisions if your investment thesis is sound. Now, I agree with this, for someone like myself who's a long term investor. But what you do have to recognize is sometimes short term price movements are telling you something, right? It might say that a risk that you overmissed or you missed, overlooked. It might say, and trial you to double check all your due diligence. And so don't just be like, oh, willy nilly, let's DCA into things, right? For example, if something comes out and there's a big news article, take that to heart. Recognize whether or not this shows that the company has a cracked culture that's going to continue to fester if you don't leave it cut off, right? So think about those sorts of things. The short-term price movements are giving you an opportunity to see glimpses into the future, right? So if you're seeing a big price run up, it's going to show you, hey, this thing might have running room, right? Or it could just show you that you should take your money and run. But either one, you can kind of think about it and use this as an opportunity to kind of look. But it doesn't really help those that are short-term price movement sort of enthusiasts, like swing traders or day traders or something of the like. So this is more focused around somebody like myself and Chris. Also, when you find a company that you truly love, takes an opportunity to go full swing into it. Pay attention to cash flows, not just the earnings, which I agree with heavily. Cash flow indicates how much money is actually coming into the business. And this is something I praise a lot, because a lot of people are saying, well, Palantir is losing money. Why would I invest in Palantir? Why would I invest in Palantir? But Palantir has been cash flow break even now for many, many quarters, almost probably 2 years at this point. Their cash position continued to stack on top of itself, but people would just be worried about the net income, gap net income, gap net income. And I think a lot of that had to do with the fact that people didn't have the education or experience in reading cash flow statements or net earnings statements and stuff like that. So now it's not good. That net earnings does reflect that share-based compensation was out of control and things of the like. So it's not to say that you have to disregard net income entirely, but when it comes to how healthy a business is generating cash and actual cash, physical cash to kind of keep the business afloat, the cash flow statement is probably the most prudent thing to look at rather than a net income statement, because net income, they can throw in a lot of gap sort of one-off items that really throws you through a loop. Let's just say, for example, an investment in one of these SPAC companies that Palantir made back in 2021 goes to the moon, that would show up on a net income report of, say, several $billion hitting net income, because let's just say it goes to the moon. And next thing you know, you're sitting there and be like, oh my God, let me put all my money into Palantir. It's like, well, the underlying business of the software creation, the cash flow that generates, technically isn't receiving the cash through the door. It's an equity position. So just as fast as it went up, everyone saw how quickly some of these SPAC investments can go down. So just like Amazon with Rivian. When Rivian IPO'd, Amazon was able to write up $10 billion worth of net income on their net income statement. I forget when that was, 2021 or 2022. And just as quickly, you saw the price deflate and the net income being hampered by their 10% ownership in Rivian very quickly soon after. So just kind of keep those sorts of things in mind. Infrastructure construction companies can benefit from increased government spending. Beware of policy impacts. Yeah, and if you look at like the energy industry as well, they talk about the Inflation Reduction Act. They talk about a bunch of different things as well. So like the infrastructure bill that was passed several years ago, that was a huge tailwind for companies like Caterpillar and stuff like that. So you're able to get many years worth of growth very quickly because of the future cash flows and the people recognizing that. So people piling into the stocks, and that might be an opportunity for you to get out quick and capture profits way ahead of time and redeploy that, or hold on to it if you know that the benefits of that company are going to be much longer winded than what you're kind of thinking. Regional and local brands have growth potential, but face risks from larger competitors, weigh opportunities versus threats. I agree with this a lot as well. You have to think not all companies can go global like a McDonald's, and not all companies can shift and tailor things to specific tastes, right? So, uh, going to McDonald's in Germany is going to be very different than going to McDonald's in the US. They will have their similarities, but the products will be slightly different, right? And just if you were to go to Italy versus Germany as well, the products would be different. If you go to India, obviously the products would be very different there than they would be in the United States in terms of McDonald's products. So sometimes they have to tailor that opportunity. But that being said, sometimes you have people might initially say, well, they both sell coffee, like Bros and Starbucks sell coffee. They're not going to do well. But Bros has a really good energy drink, a really good tea, a really good like milkshake sort of atmosphere to it, rather than specifically coffee, which Starbucks kind of has that niche in, right? So management quality is important. Look for discipline, capital allocation, and good corporate governance, as well as good corporate culture. I think it's huge as well. Once you see companies get too big and the churn of the organization has come in so long, old people have moved out, new people have moved in, the culture of the company changes. And I think sometimes that's one of the biggest parts of like understanding the culture, understanding the purpose of the organization, and keeping that in the front of everybody's mind so that way it doesn't get lost through the trees, right? So just good thoughts on that one. And understand how technology evolves and disrupts industries. Existing big tech firms have advantages, but new threats can emerge. Take BlackBerry and the iPhone, for example, right? And nobody really thought that would happen. Look at Yahoo and Google, right? Yeah, everyone was using yahoo.com, Ask Jeeves, and then Google came out and dominated search for the longest time. Internet Explorer was probably a huge thing. Then Mozilla Firefox was big. Now Google Chrome owns that. So these sorts of things can change very quickly over time, and it's like, wait, I completely forgot that Mozilla Firefox was the thing. Now, like I don't know, 70 or 80% of people use Google Chrome, so it's pretty cool to see that difference over time and different technologies and how they move within the ebbs and flows of society. Keep an eye on relative valuation. Some of the companies in the same sector can provide useful information or comparison points. And I think that this is true as well. You can kind of look at, how much would a company be trading for if they meet their growth potential, right? So everyone might be looking at Bros right now and say, man, their PE is 25,000, right? Like, come on, man. Like, this is the sort of stuff where it's like if a company's PE seems out of sorts, like it's a PE of 1 or 2, or it's a PE of 25,000, any reasonable investor with a little bit of experience would be going on into looking at the cash flow statements and the earnings statements to kind of understand what would be useful or what is actually true in that standpoint versus the they would then soon realize that it's the first time it's been net income positive. It has to grow into its valuation. It just got the EBITDA is there. So anybody kind of looking at some of these things, just needs to take a step back and learn a little bit more about how to read things rather than just take it for word for word. Not everything is white and black, which you then soon find out in the investment world. But this all leads back to kind of my 5 key investment things that you need to look for, right? I always talk about an objective. What's your time horizon? We always talk about what's your risk tolerance, how much money you're going to be adding every single quarter. We always also talk about how active or passive you want to be in these investments, and that helps shape um, the world of how you shape your investment strategy and how you think you're going to go forward and how you'll sleep at night. Not to say that will be set in stone, right? As your portfolio morphs, you can morph and mature with your portfolio and vice versa. When I was originally starting to invest, I didn't want to get caught with my pants down and in a layoff or something like that. So I was very focused on dividend income and making sure that I had that sort of income. Once I got to the point where dividend income was kind of inevitable with the portfolio size I was getting to, I kind of wanted to get to the point where I could look into getting closer to the 8-figure mark, or maybe even set myself up, which this is a huge stretch goal and likely to never happen, but potential run for a 9-figure mark in the portfolio. And so just thinking about that sort of thing really got me fired up, as opposed to just like, hey, if I need the dividend income, I could have it. I could sell off and move things around. But anyway, with that, let's hook it up into the conversation that's been ongoing in the chat. There's a little bit in here. Um, Hopefully everyone's doing good. ETF FaceTime, what is going on, my guy? Thank you for those articles. Those were really cool to be able to see. Let's just see. Yeah, let's just see. Gave up so quickly. I don't know what he's talking with reference to there. Yeah, the muffin tops are good. I've had, and the granola bar is really good if you haven't had it as well. But I'm here for any questions that you guys have. I'll probably what's going on, Korea? Hope you guys are doing well. Hopefully this helps in any sort of way or form by investing uh, in Asia Pacific as well as the United States or the UK or wherever you're watching this from, for anybody else that's out there. But I'm open to answer any questions for the next 5-10 minutes. Nobody does, then I just wanted to share that um, with folks because I thought ETF FaceTime provided that, and I thought it was really cool to be able to see. So hopefully everyone is doing well. And the first question I'll answer is: Dutch Bros a buy now at these prices? I think it all depends very much on what your investment objectives are, right? If you're looking for something that's guaranteed, I think the S&P 500 would be more guaranteed than, let's say, a Dutch Bros. But I think that if Bros is able to live out and meet their growth expectations, I anticipate it'll be a 5x in say the next 15 years or so. And so I think that would outpace the S&P 500 personally. So we'll see. What's my take on PayPal? I know this is a controversial take on PayPal. I've seen and looked at a little bit of the cash flow statements and income and looked at the metrics and stuff of the like. To me, if PayPal was still so valuable, Elon Musk wouldn't have sold it as early as he did, right? I think Elon recognized, his contributions to PayPal were great, and he was able to get out, and he was able to use that money to start other businesses. And I think he saw that where he could take PayPal is probably peaked out at the price that it is right now. Not to say that it's not a good business, not to say that it doesn't generate cash, but to me, if I'm going to take money and invest in a speculative bet, which is the majority, or things that I know that are probably more secure than the S&P 500. So I'm thinking Amazon and Google probably will outpace the S&P 500 with lower risk than the S&P 500. Doesn't mean lower volatility, lower risk. Then you have Palantir, Rocket Lab. I anticipate that those will be, for Palantir, at least a 10x sort of opportunity with medium-ish risk, but we're getting closer every day to that going to a low risk. Rocket Lab going from a high to medium risk as we continue to get more and more closer towards profitability. I think that has a 20 to 50x potential. So when I look at a PayPal, I'm like, okay, well, what am I trying to achieve at PayPal? Am I trying to just get a 50% return and then run away? Or am I trying to, and so to me, it's like if I'm just trying to get a 50% return, I feel like I could do that with other investments that I feel like I can hold in the longer term. I don't think that PayPal is going to grow into a 400, 500, $600 billion company. I could be wrong with that. And I know a lot of other people really like it, but I just don't see the long-term innovation. And for those of you guys that know, a lot of my portfolio is just invest in the S&P 500 just as a parking ground. And so, I could see it making a little bit of money, but I'm more so focusing on companies that in 10 years, 15 years time will have a massive growth potential. And I just don't see PayPal having that. I feel like it'll get to that 50% return, maybe 100% return, and then kind of stop out again. And I think a lot of people are living in the days of what happened in 2021 when all these fintech stocks were doing really, really well in terms of market cap. And and I think a lot of people will probably take this and make a clip of it or anything like that and say, hey, it's at $60. It went to 100. You're an idiot. And I'm like, okay, that's cool. But I honestly don't think it'll go back to 150 or $200 a share. I just, unless they continue a very aggressive buyback plan, maybe in the long term. But at that point, I feel like I would have made more money in a different investment personally. That's likely to be more innovative, more company or world changing than say a PayPal. And I go back to, a lot of people didn't really understand what I was getting to. If Elon wanted to sell and make more money, sell Tesla stock and make more money, why did he buy Twitter and not buy back PayPal? Right? He obviously sees much more potential for his money, the 40 odd $billion that he was able to combine to buy Twitter, and the value at which he could grow that in the long term than he did at, say, PayPal. Right? And keep in mind, Elon was a PayPal creator, right, and co-founder. So just makes you think a little bit, right? If it was still so valuable and there's still such a long runway with PayPal, why wouldn't Elon buy it back, right? With all the money he's made from Tesla. So just some thoughts there. Um, I know those are controversial takes, but Pouncer Weekly tonight, we'll see. I don't know. People keep talking like, oh, this person's the best content creator, and that's like as if they've never watched Palantir Weekly. I'm not saying I'm the best, right, or the most articulate, but I feel like I bring probably some of the best value when it comes to Palantir Weekly to the community. And I know I can't speak on specifics, nor can I share graphics or anything like that because a lot of that has proprietary data. But all these people, when you think about it on Palantir Weekly, I would say there's about 10% of the people that actually come on that actually have experience with the product. 90% of the other people are just talking about hearsay, things that they read online. And it's not to say that they're wrong, but isn't it useful to hear from somebody that actually knows and has used the product before? I'm not a power user like CodeStrap or anything like that, but it's super funny when people will put the thoughts and just because somebody's better articulate or better hype man, they'll put the thoughts and love and enthusiasm into another creator versus somebody who's more realistic and has used the product because it aligns more with their strategy. And so they're more leading themselves with emotions or hopium than actual logic, which bothers me to an extent. And so that little like toxicity around like, oh, this person's the best content creator, blah, blah, blah. It's like, who the fuck cares? We're all creating great content. And like, just because somebody made a little bit of content doesn't mean you can throw everybody else under the bus. Um, but that's just my thoughts with respect to that. So we'll see. Amit hasn't sent me the link yet, so maybe he might take a pause. There's always that possibility as well. Being in the UK, content is crucial for research, etc. The UK is a heap of junk for investing. Hey, man, there's some great opportunities in there as well. You can't throw it under the bus, but the UK is just a different beast when it comes to the market. The FTSE 100, is way different than the S&P 500. I don't really necessarily know the criteria to which the FTSE allows people in and out of it, but the S&P 500 does a really good job making sure companies are profitable, and I just really enjoy that model. So that's just me. How do I feel about Chewy? I don't know anything about Chewy, man. No offense. I'm not, not downplaying your pick, but just don't know anything about it. Energy sector picks. I try to stay a little bit away from picking if there was a little bit more turmoil in the market right now for the energy sector. And when you say energy sector, I'm assuming you mean oil and gas. I have a lot of Shell and I have a lot of UDOC stock. For those of you guys that don't know, UDOC is an undisclosed oil company I work for. So with that, I generally don't add a lot of energy picks, but if you were to talk about long-term renewables or anything like that, NextEra Energy, I think is probably one of the most prudent opportunities to look at. I would have to look again at their cash flow statements to an extent, but I think that they're making a lot of good investments, and I think they've retraced in price a good bit. If I remember, let me pull it up in the background here. NextEra, yeah, they continue to pull back, and so their price to earnings is shrinking, which is a good thing. And they're not stopping, right? So their earnings are only going to continue to grow from here. So I honestly might take a conscious effort and buy NextEra if it continues to drop on the market. And I think because what is it now? It's a $137 billion company. So just some thoughts there. Um, Poor macro, slowing velocity of money. Feels like you're on right with PayPal. I mean, there's people that say the international use of PayPal has continued to explode. Uh, for me, it's just I think it's a trade. It's not an investment, right? And take that as you see fit, right? Just because I say it doesn't mean it's not, right? Chris and many others view it with a really good light, and they might be looking at it more of a trade or a leap or something like that, or an options swing trade or something like that. And generally speaking, I just like to hold on to things and sleep well at night. So not saying they're wrong, right? And I have taken some trades, but I'm going to be in a trade because I think it's going to be much more than say a 40-50% sort of return. Or if it is going to be a 40-50% return, I would want it to be in a quicker pace than what I think PayPal would be. Any thoughts on Pfizer? It's super low right now. I haven't looked at Pfizer since probably early 2022, so I don't have any thoughts on it. So apologies. Did I have to get Palantir certified? They offer a certification, don't they? I did not get Palantir certified. Um, I don't think there was any low blow and emit with what I said. I think somebody else um, some new streamer or some new content creator came up and they said everybody else in the Palantir community is awful. Meanwhile, Amit, myself, many others have been putting in a year or a year and a half worth of effort to just throw us under the bus for some random person who's never used the software or put in the work that any of us others have is kind of sad to see. So no, at any point was I talking about Amit being less useful, right? I was just saying and stating a fact that 90% of the people on Palantir Weekly and others have yet to use the software. That's not a low blow. That's just a fact. But with respect to getting Palantir certified, no, I did not get Palantir certified. They did start offering a certification, I think. CodeStrap would be better in that. For me, it was just utilizing when they started kind of rolling out Foundry to commercial companies as opposed to using it in kind of government. In fact, I don't even think they really used Foundry in the government too much. Maybe they do now, but when they first started rolling out Foundry in commercial companies, I think it was like our company, Airbus, and a few others where they were just starting to trial it. And luckily they changed a bunch of stuff used to be called Chronicle, then it switched to Quiver, then it switched to something the other day I used to call it Reports, and now I forget what it's called. Like it switched. So just because something is the way it is, sometimes it'll switch up, and it bothers me a little bit. Sometimes I'll be like, oh cool, let me just go check this, and it's like this no longer works. I'm like, crap. That's never that hard to recreate, and generally speaking they have a button to convert and stuff like that, and it's never that bad. But sometimes when you think you know something, you really don't. So it is what it is with respect to that. But no, I'm not certified. I have thought about getting certified though, just for future potential. TSLY has been mentioned a lot lately with 60% return and dividend. What's the risk present, and any thoughts while you're all in? Yeah, definitely not all in. That was a joke. I know you know that, but I think that a lot of people are going to get burned by TSLY, just like a lot of people have gotten burned by any things like that, like QILDs and stuff of the like. I think the problem is people know enough to be dangerous and not enough to get themselves out of danger. And by dangerous, I mean like a good dangerous, right? So they know enough to get themselves into a little bit of potential, but they're not smart enough to recognize that risks can kind of come in from all different sides and really eat away at any opportunities that you might be looking at. So I think just in the long term, Tesla's going to be pretty volatile, and as it continues to swing up and down, um, unless there's some steady incline over the course of several years, which I don't foresee. I think there's going to be, if there is going to be an incline, a rapid incline, and then a rapid pullback and a rapid incline, rapid pullback. I think that's just death to a company or a stock or an ETF that lives off of low volatility covered call income generation. And what I mean by that is it says it's stated in the specifically stated in the prospectus. They write options 5 to 15% out of the money on the strike price. So let's say you have a big pullback, it goes to $100 a share, and they write an option because they have to, because they're generating income. That's an income focused perspective first. They write it at 115 for their covered call, and the stock, because it never really stays flat for that long or goes down for that long, shoots up to $200 a share within a month. Well, anything above $115 is either going to be trading at a severe discount, or this is not going to be showing up on the ETF growth. So TSLY will be able to benefit from that initial 15% return, but anything after that is muted. Now you might say, well, Tesla, 15% in a month is pretty good. But you look at Tesla, what it'll do is it'll like consolidate, drop very quickly, because people are moving in and out of it. And then it comes right back up. And it's like, if you're caught in any of those months where it dropped, say 30% over the course of several months, and now it goes back up, you're kind of effed. And so you're almost fully exposed to the downside, and then you're muted on the upside. And so those ETFs are a little bit challenging. You need to recognize what covered calls do. But back to the UK, not entirely. We can buy the FTSE easy enough. Just felt that the US is way better market leaders. Yeah, I think it all just depends on what you're looking for and what your objectives are. I know a lot of companies are very much into dividend income over in the UK. And so a lot of them are pretty mature businesses as well. When will you retire? Plans? I mean, it all really depends, man. Like, to me, I'll never stop working per se. If anything, I'll be transitioning more towards like a YouTube sort of streaming, or like a daily show, or investment focused sort of career, whether that's in real estate or what have you. But I like what I do right now. I mean, I'm a reservoir engineer. I work in the Gulf of Mexico, bringing on a lot of oil for people to use on a day-to-day basis. So I'm having fun with it. So for at least the next 2 to 3 years, I don't really plan on doing anything different. So, Matt, any reason why you're not going to Microsoft? You just think Google and Amazon have better return on investment long term? I got all three, but allocation wise, Amazon is greater than Google, greater than Amazon. Or sorry, Amazon's greater than Google, greater than Microsoft. I don't hate Microsoft. I think the thing that surprised me, and this was just when I was learning about really how to value a company like 5 years ago or so, right before the pandemic. I just didn't see, I just knew that Amazon was the king of web services, and I just kind of took that for granted, and it never worked in the balance sheets at all or the cash flow statements. And then Microsoft, everyone's just like, yeah, Microsoft's going to freaking rule the world. And I just didn't really foresee that the cloud revenue would explode like it did for Microsoft. And so I never really initiated a position. So that's unfortunate, but I also noticed that it was always trading at a pretty significant premium comparatively to Google. And so I just anticipated Google had a lot more pokers in the fire for future opportunities as well. So there's that. What's up, Hot Chris? Hope you're doing well. ARM IPO, I don't know much about it. I know Chris does. So Total Energy has been very good. I know they pay a good dividend, but yeah, Total knows what they're doing. Let's see. Government and the way the UK structure stuff makes it a bit harder for businesses, etc. Regulations are good to an extent, but you can't over-regulate. Otherwise, it really constricts businesses. So look for you companies, definitely. Let's just see. Most people in PayPal are in it for the short trade, 80 to 100 and out. I don't see a long-term future in it for that competitive space, in your opinion. I'm in the same boat with you there, my guy. Completely agree with Nextera. It's a sleeper in the market. Great tailwinds and efforts in a new hydrogen technologies as a side catalyst. The thing that's very interesting, I know a lot of super major oil and gas companies, maybe even UDOC, are very much into the hydrogen space, and um, it's something that I'm very curious how it plays out because, and I'll only probably do a couple more minutes because I don't want to um, take up too much space on anybody else's streams. But the thing that I like about NextEra is just their renewables portfolio, and they're doing it very profitably, and they're not doing it at a very expensive price to earnings. And so I think that in terms of where they think they can go. And the long-term stable cash flows of it, and how quickly they're going to bring on additional infrastructure, will do really, really well. And I've been meaning to do a little bit more deep diving to ensure that if it dips anymore, like another say 5-10%, 5-10% is probably too little. If it dips another 10% or something like that, I might start writing puts on it and hopefully try to get assigned because I think it's a good opportunity. And I'm upset that I didn't listen to a friend back in 2019, 2020 about NextEra. But funny enough, the prices, I want to say, just like how Amazon, like this is pretty kind of cool. I mean, this is just the cool things that the stock market does. You know, back then, because of the ESG push and everything like that, it was trading anywhere between 50 8 to the low 60s, and here we are, the mid 60s, and look how far since 2019 NextEra has come in terms of being able to get the renewable infrastructure online and stuff like. So I'm able to get 4 years ahead, 4 years additional work, 4 years additional infrastructure in the ground, right? So sometimes it pays to be patient, right? And I know that a lot of times we talk a bit about time in the market is better than timing the market and stuff like that. But sometimes you just have to feel your gut out and say, I don't think it's right now. And sometimes the market gives you an opportunity, but also times like this, if I did say invest in NextEra back in 2019, 2020, and I saw my friend's vision and I listened to him, it's times like this where you have to sit back and say, oh crap, is my thesis or their thesis really still out there? And I think it is, right? It's just giving you a test, just like Palantir did, right? Palantir, I wrote it all the way up to $45. I didn't sell. I was selling covered calls, made money off of that, but it came back down to $10. It gave me a thought. It's like, here I am now. The revenue had doubled at this point. Things are looking good. So am I going to get out of it, or am I going to keep riding this pony? And here I am still in it. So I think that this is interesting. But with respect to the hydrogen stuff, I understand from a large industrial perspective and planes and stuff like that, the opportunity in the market that could grow. But anyway, just some thoughts with respect to that. So yeah, I think it's going to be more challenging, and I think it's going to be a lot more competitive than people give credit. Just some Mr. Don't to be assumed to say, hey man, I mean, if you don't think I'm doing anything amazing, that's cool. That's your opinion. You don't have to feel obligated to watch the channel either. You can spend your time doing something else. It's not a pain for me. And hopefully the other 45 people that are watching are getting a good opportunity into my mind, and hopefully learning some stuff. Thoughts on Black Sky? I like Black Sky. I don't have a position as of yet, but it's something I'm looking into. Specifically, they continue to they work a lot with Rocket Lab, which I'm long on, and the photos that come out of their shop are pretty good. The thing that I'm bothered by about is they're not yet cash flow break even. I'd like to see them get to that point. And so my fear is their revenue growth compared to where they SPACed is way down, or their projections versus their SPAC projections are way down. And I'm curious if that's just the pandemic related or what have you is really driving that. And so with that, I'm just waiting a little bit more to make sure that revenues are going in the right direction and EBITDA is going in the right direction. I think they're only like within 10 million or something like that of break even. So hopefully it continues to do well. Amit attending AIPCon is huge. Is he attending? I didn't see that he was yet, but if he is, congratulations. That'd be awesome. Any stocks on my wish list? I'm just accumulating. There's a few like Blacklist is on my list. There's a few that I already have investments in that I'd like to continue to grow. But Next Era, Black Sky, those are ones that I'm currently that I don't have positions in that I'm giving a good look at right now. And if there was any screaming opportunity, like if we go down another 20-30%, I wouldn't mind buying those opportunities. Most important question is: did you start looking at the valuation of those Pokemon cards? Haha. I did a little bit, but it wasn't anything too crazy. I mean, we're talking at most a couple $100 per, and for me, you know, it's not going to move the dial, right? So, if it was a couple thousand, we might be talking. But anyway, super high dividends that can have staying power over long durations are a handful of closed-end funds trading somewhat close to NAV with blue chip fund managers. And I think it all depends too, right? Like, do you need dividends, right? Because Chris had a good example of this the other day. It's like if you're buying something for specifically for dividends, you might be getting a 5% dividend yield or something of the like, but then you're opening up the government to asking for their share of the dividend income. Right now, very different if you say are the what was I going to say? They are in like a Roth IRA or something like that, or if you're making less than $50,000 a year. But other than that, man, you're going to be opening yourself up to having to pay the tax man. So, yep, exactly. You're sacrificing, risking total long-term returns, compounding. 10% dividend opportunities are a blast to research. Let's just see. Wilder, what's going on, my guy? Has fracking reduced Gulf industry? Why would fracking reduce it? Fracking, for those who don't understand, is basically we use it as a filter. And I don't want to talk too much about it because some people politicize it too much, but we use it as a sand filter, as a sand control mechanism. A lot of the sands that we produce, the reservoir sands that we produce, are very unconsolidated, meaning they're not like actual rocks. So we think of them as rocks, but when you think unconsolidated, think about like, have you ever picked up a rock and it's like a sandstone, you rubbed your fingers against it and the sand grains actually get under your fingers? Or if you think about unconsolidated, think about the beach, right? That's unconsolidated sands. So if that's the case, and that's what you're kind of producing into, you want to have some sort of filter to make sure that that doesn't fill into your wellbore and stuff of the like. So we use fracking almost as a mechanism to hold back the reservoir and also to get past any mud that might have been used while we're drilling it. So to make sure that we get good communication with the reservoir. Fracking, generally speaking, is used to increase production. So I'm not entirely sure I understand your question. So yeah. I have a friend who invests in Ulta, and he's done really well with it. And I know, is it Jeremy that invests in Estee Lauder? Okay. Okay, good for him. I'm excited. That'll be awesome. I don't know what he's presenting on, but hopefully the community or something like that. That'd be cool. Will you do something again, looking carefully at a financial statement? I liked what you did with Chris, but you used that fictitious lemonade example. Sure, Laura. We go through I've done it multiple times before, so it'll be something that we do pretty regularly. So the fictitious lemonade example, I can understand where you're coming from. It just like throws up a bunch of lemonades and it kind of makes you feel like it's not worth it. But at the end of the day, it is a very good example. And so I recommend, that's one of the better ones that I've seen. But one day maybe we could look through and get rid of some of the myths of walking through a cash flow statement, net income statement, and stuff like that. And I'm still learning too, right? So by no means am I like an expert on all the different line items and stuff like that. Um, so, um, let's just see. Oh, it went all the way back to the top. That's why I was like curious. Mm, late yesterday. Alta seems cheap. Yeah, he says Alta is really cheap. Um, let me see. Maybe it's a two-parter. Matt, just wondering, in general, has fracking reduced Gulf of Mexico oil production? Industry, not UDOC, is on land development cheaper than going deep water? Are these two separate questions? But yes, land development is generally speaking cheaper than going deep water. The risks um, are way higher deep water. You have to use floating mobile operating drilling units versus land rigs. Land rigs are much cheaper. So, thoughts on Rivian? I don't hate Rivian as a company. I just don't really know much about the stock, and I guess a part of it, if in my investment with Amazon. But um, so let's see. Yeah, Jeremy owns Elf. Yeah, thank you. Um, Options. Yeah, if you guys ever have questions about options, just keep up with the channel, and Chris and I'm sure we can help you out with that with respect to being able to get options. But for those who don't really understand options, you have to recognize it's a very active, more high um, or advanced sort of topic for people. If you don't really know how to trade the stock market, trading in the options market's even worse, because you really have to understand, like, stocks. When you invest in stocks, it goes up, down. You can short, which switches up if you make money, if going down versus going up, whatever. But um, when it comes to options, it amplifies things a good bit. And with that, you can do hedging, leverage, all that sort of stuff. And so, if you don't really understand the stock market entirely, I suggest holding off on the options market. But the options market can be really useful, specifically to help with a little bit of income and stuff like that. Thoughts on eVTOL stocks like Archer? I don't know any. But all right, well, I'll give another minute or two for some things to kind of come in. But as always, I appreciate you guys hopping on. I know it was kind of an impromptu guy, but I ended up going a little bit longer than I thought. But as always, love helping anybody out that I can. That's why I do these things, right? I barely get paid for any of this stuff, and that's not the reason why I do it. I do it more so for helping people and hopefully making connections like Chris and Amit and many other people that I've met along the way that I'm able to collaborate with and hopefully continue to do more and more with in the future. So think if there's anything else coming through. It doesn't look like it, but if anything, you guys have my Twitter, and that's pretty much that. You can reach out to me, DM me. You can reach out to these in the comment section with these videos and stuff like. But otherwise, I'll talk to you guys in the next video. Cheers.